In our first part of our lecture, we're going to focus primarily on bonds and learning objectives 1 through 6. And then in the second half, we'll look at learning objectives 7 through 9. So to understand why we have these things called long-term liabilities, it's very important that we understand a company's money or resources, their capital structure, refers to the mix of debt and equity that it must have to finance its operations. A company's use of debt to increase earnings by investing borrowed money in assets that generate profits that are greater than after-tax cost of debt, and using those excess profits to increase the return on equity is financial leverage. So what we're talking about here, and it takes you back to the simple accounting equation of assets equal liabilities plus equity. So assets can only be purchased through the incurment of liabilities or equity. So what we're saying in the second point is sometimes the company has to use debt to increase earnings to actually operate. And they take that borrowed money and put it in assets. Those assets are used to then generate a profit. The goal is to make that profit greater than the after-tax cost of the debt. So you'll make more money than you have to spend in interest, and that in turn helps increase the return on equity or the return to the shareholders, the owners. Financial liabilities are contractual obligations that require one entity to deliver cash or another financial asset to another party. Now, why companies issue these long-term debts or liabilities? Debt financing may be the only available source of funds, so they have to borrow money. Debt financing typically does have a lower cost of capital than equity. So interest is usually lower than having to pay dividends. Debt financing offers an income tax advantage because interest you pay on debt is deductible on a tax return, where dividends generally are not, or only a limited amount maybe. Debt does not carry voting rights. You don't have someone running your company with debt. And it offers the opportunity for financial leverage, what we just talked about. So, the first major type of long-term debt we're going to talk about are called bonds. Now, I remember learning about bonds and just shutting down when I first started learning about them. I just couldn't grasp them. So I'm going to make this as easy as possible for you to truly understand what this whole concept of a bond is. First of all, a bond is a debt instrument. It's a loan, okay? It's a loan the company takes from the general public. Instead of the company going to a bank and asking to borrow money, they sell bonds, which is really borrowing money from a bondholder. The company promises two things to the bondholder. They promise to pay them a face value, an amount on the bond, which is proof of a bond, and they also, at a future date, and they also promise to pay them interest at certain times at a certain rate that's on the bond, and they calculate it using the face value of the bond, the amount that will be due when the bond matures. So all a bond is, and we say we sell a bond, the company sells a bond. Well, they're not selling equity, they're selling a liability. Their liability. They're saying, person buying this bond, you give us money, we'll pay back to you in the future a face amount that's already on that bond we handed to you, and interest at certain periods of time, usually annually or semi-annually, based on the face value of the bond, the amount on the bond, and the interest rate on the bond. So face value, or you'll hear it referred to as par value, is the amount of money that the company agrees to pay to the bondholder at maturity. It may not be the amount they borrow, it's what they promise to pay back. Maturity date is the date on which the issuer or the company agrees to pay that face value to the bondholder. Now these are important. The contract rate. And there's like 3 or 4 different terms we use to describe this. Stated, face, nominal, contract. That is the amount of interest the company promises to pay to the bondholder. They use that interest rate. It's stated on the bond. It's in concrete. It can't be changed. It can't be whited out. Nothing. It's in concrete. And the bond certificate is just this bond that says, hey, whoever holds this owns this right to money in the future at the face value and interest payments. A bond indenture is a document that defines the rights of the bondholders and the obligations of the issuers. So there's different characteristics of different kind of bonds. Debenture bonds are bonds that don't have collateral on them. So a company sells a debenture bond to a bondholder. The bondholder buys that with the good faith credit of the company selling it. Mortgage bonds are secured by a lien against specific property of the company. Zero coupon bonds are bonds on which the interest is not paid until the maturity date. Okay, so they don't pay any interest during the time the bond is held by the bondholder. They get the interest when the bond matures. Callable bonds are bonds that the company has the option to retire early at a predetermined price, and we'll look at that later on. Convertible bonds, and we'll look at that in our second part, are bonds that give the bondholder the right to convert the bonds into common equity, so common shares of stock of the company. And then serial bonds. Serial bonds are issued at one time, but mature in installments. Now, when a company issues bonds, it just doesn't one day say, hey, we're going to issue bonds today. Yep, we're going to be selling bonds. Okay, it's a process. First of all, the board of directors gets together. So let's say today, February, I'm doing this on the 20th, says the bondholders get together and say, or the bondholders, I'm sorry, the board of directors gets together and says, we like to sell bonds. They look at information with their accountants and their lawyers and they say, yeah, we're not going to be able to sell them because we have to go through a process. We need to receive approval from regulatory authorities. We have to set the terms of the bond. The accountants have to talk to us and tell us what we can afford and things like that and do all kind of workups there. We have to announce it and we have to print the bonds. So the day that the board of directors gets together and says, hey, we'd like to sell bonds, could be 2 months, 3 months before they even first sell them. Now, I'm going to sneeze. Excuse me. So let's say today they get together. I'm sneezing. Ooh, sorry. I'm probably going to sneeze one more time. Let's see if we can get through this now. The bondholders get together February 20th. I did it again. I should start over. The board of directors of the corporation gets together and says, we're going to sell bonds. But they know they have all this stuff that they have to do. So this is going to take some time. So they say, you know what, we're not going to sell them probably till May 1st is the first day we can offer them for sale to the public. Today, when they're getting this bond information together, they have to decide how much money they need and more importantly, what kind of an interest rate they're going to pay on those bonds. Because remember, they have to pay back the face value and they have to pay interest on the face value during the time the bonds are out there. So they got to look at those things. Time passes. Please keep that in mind. So the selling price is based on the terms of the bond issue and factors such as the general bond market, the risk of the bonds, and the expected state of the economy. So they look at all these things. What's very important is the first day the bond is sold, what is the effective or market rate of interest? What does this mean? This means on May 1st, the company who has already put down on a contract, a bond certificate, we're going to pay back face value in this amount of time, and for the next so many years, we're going to pay you interest on the face value at this interest rate. That interest rate was decided weeks ago. It had to be, because it had to be put on bond certificates, and they needed to be printed. The accountants did the workups on it. All that stuff is already done. Well, now comes the date of sale. And the market, what these bonds will actually sell for, will depend on what other bonds similar to that are paying an interest. And they're not all calling each other up saying, what are you going to sell your bonds? What kind of interest rate are you putting on your bonds? What kind of interest rate are you putting on your bonds? No, the market will decide that, and that changes daily. So that's important. That's a different interest rate. The stated rate is what the corporation promises to pay on the face value, and that is in stone on the contract. Can't white it out. The market rate is what the bonds, similar bonds in the market are paying interest at when you first sell them into the market. Now, as we said, serial bonds are issued at one time, paid over installments. I talked about this already, so I'm just going to kind of go through it, and you could take a read. Here's where we get into the complications of interest rates. First of all, the selling price of a bond is not the face value necessarily. The selling price of a bond is the present value of two calculations. The principal that will be paid at the end, or the face value, and the interest payments that will be made annually or semi-annually over the life of the bond. And these two payments, future payments, are not discounted at the stated rate on the bond. No, they're discounted at the market rate of interest, or what we call the effective interest rate. That's how much a bond will sell for on its selling date, not necessarily the face value. So there's three alternatives. Now think about this. Purchasers of a bond pay the face value of the bond at par value. When will the bond selling price equal its face value, or the amount that's promised to be paid at the end? You want to jot this down. When the stated rate of interest, so what the corporation promises to pay over the life of the bond, is equal to the market rate of interest. So no matter what bond you buy, you're all getting the same interest. So the bond will sell at its face value. Sometimes the purchaser of a bond will pay less than the face value. When does this occur? When the market rate of interest is higher than the stated rate of interest on the bond. Let's think about this. Let's say your company is selling bonds. Your interest rate on your bond is 6%. So you're promising to pay your bondholders 6% interest. But the market rate of interest is 8%. Think of it from a purchaser's side. Would you buy a bond at 6% interest or 8% interest? Of course you'll want to buy the one at 8%. It's paying you more interest. But the corporation, us over here offering our 6% bond, really want to sell our bond. Remember, we can't just white out 6% on our bond certificate and put an 8 in there. No, we're locked into 6%. So the only way we can get people to buy our bond is to discount it or sell it for less than its face value. Face value is what we pay back at the end. We'll just have to take less money up front. And then finally, a premium. The opposite could happen as well. If and premium is when the purchaser pays more than the face value of the bond. When would this happen? Our stated rate of interest on our bond is 8%. The market rate is 7%. Think about it from a purchaser's perspective. You can buy a bond that pays 8%, or you can buy some other bond in the market that's only paying 7%. There'll be more of a demand for our bond that's paying 8%. This will drive the price above the face value. So purchasers will pay more than the face value, or the company will receive a premium. So those are the three ways a bond may sell. Take an example. Jet company decides to sell 100,000 5-year, so there's your maturity date, 5 years, 12% bond, pays interest semi-annually, interest at 12%. So that's 6,000 every 6 months, 100,000 face times 12% times 1/2. And the effective or market rate of interest is also 12%. Here's how we compute the selling price. We determine the present value of the principal. The present value of the principal, and if you draw a timeline, you want to know what's today's value of that one-time payment at the end of 5 periods. And you use the market or effective interest rate to determine the discounting. You would use 6% in this case and 10 as your N. Why? Because you base it on the number of interest payments, and remember, when interest is more than once a year, you have to divide by the number of times a year. So twice a year, 6%. So there's your factor. The other part of the computation that will determine the selling price of the bond is the present value of an ordinary annuity. Remember that calculation. What are interest payments? They're really an annuity. What does this company promise to do? It promises to pay 6% on $100,000 every 6 months, basically. So $6,000 twice a year for 5 years. So the payment portion of the annuity would be the interest, or $6,000. You would then find for the present value of an ordinary annuity, because interest is paid at the end of each period, end of each 6-month period, 10 would be your N, 6% would be your I. And it's not 6% because that's what the company's promising to pay. It's 6% because that's the effective interest rate right now. You determine those two present values, and that's the selling price of the bond. So you can see from our calculation, when the stated rate on the bond, what the corporation promises to pay, equals the effective or market rate, the selling price will be the face value of the bond. Now, how will that change if now they're going to sell these 5-year bonds that pay 12% interest semi-annually when the effective or market rate is at 14%? Now watch how our calculation changes. Here's our calculation. The present value of the principal. What is the principal? The face amount that will be paid at the end of 5 years, $100,000. That is promised. It's in the bond certificate. How do we discount that? We use our 14% interest rate, but we divide that by 2 because interest is paid twice a year. So 7%, 10 periods. Present value of 1, because that's a one-time payment at the end. There's your factor, 0.508349, right off your table. You would then do the present value of an ordinary annuity. The corporation is still paying out $6,000 every 6 months because the stated rate of interest is 12%. That's what's on the bond certificate. Twice a year would make it $6,000 each interest payment. But when you discount it using the market interest rate divided by 2 because interest is paid twice a year. So 14 divided by 2 and equals 10. Add those two together. Now the bond is selling at a discount, or $92,976. So the face value is $100,000, but the company is only going to be able to get $92,976 when they sell it. So they've discounted this note $7,023.61. And if you really think about it, why did this discount happen? Because the interest rates are different. So essentially, this is interest. This is interest. instead of the company actually paying them $7,023.61, they discounted it and said, we'll take less up front. We're not going to physically pay you the money back. You just didn't pay as much as we'll pay you at the end up front. We'll show you how to record that. What happens if the company sells the bond when the effective rate is only 10% or the market rate? So now the bond certificate is still at 12% on a $100,000 face, and the bondholders are still getting $6,000 every 6 months, but now the market is only paying. So other bonds, they're only selling when their stated rate of interest is 10%, so that makes it the market. The present value of the principal then will be $100,000, the face value. So we're trying to figure out how much is that $100,000 worth today if the effective rate of interest is 10% or the market rate. Your N will still be 10. Now your interest will be 10% divided by 2 or 5%. Because it's paid twice a year, interest is paid twice a year. So there's your present value of 1, the factor, and how much the principal present value would be. The second calculation, again, is for present value of an ordinary annuity. We want to know what's the present value of those interest payments the bondholder will receive. We take the $6,000 that we have to pay to the bondholder, but we discount it using the market interest rate. So N equals 10, I equals 5%. So you'll use the same N and same I for determining your factors for both calculations. It's these two present values added together that will give you your selling price. Take a look at this. The selling price is above the face value. Yeah. Essentially, what we're saying to our bondholder is, hey, wait a second. We're paying you 12% when you could only be getting 10%. You're going to pay us some of that interest so that in the end, you're really only making 10%. And that's what we're doing. So we get paid more upfront to offset that overpayment of interest because we're paying 12 instead of 10. So premium and discounts are really just interest. They're the difference in selling price and face value due to change or a difference in market interest rate and the bond interest rate, what's on the contract. Now, there is a nice little chart. When it comes to par, your yield, or what you sell it for, equals your contract rate. So interest expense, or I'm sorry, your yield, your market rate of interest equals your stated or contract rate. Interest expense will equal exactly what you pay. But if your market rate of interest is less than your contract rate, you'll pay out more in interest, but you'll actually record less in interest expense, because you'll see why. And if you sell at a discount, your interest expense will be actually higher than the amount of interest you pay. All right, so what happens when we have an issuance of a bond? So here we go. Jet company, when they sell their bond, when the market rate of interest effective equals the stated, they will debit cash and credit bonds payable. It didn't sell above or below the face value. When bonds are sold at a discount, though, like in that second scenario, we still credit bonds payable for the full $100,000. So you always credit the bonds payable for the face amount. You debit cash for the actual cash you received. The difference is stored in a discount on bonds payable. Now remember, what is that? That's interest. We are not allowed to debit interest expense all in the year that we sell the bond. So what we do is, over the next 5 years, we will assign a portion of the discount as interest expense to each period, and we'll be looking at that. But for now, it sits in this discount on bonds payable the day we sell it. When it's sold at a premium, of course, our cash is higher than face value. So we'll debit cash, we'll credit bonds payable, and then we credit an adjunct account to bonds payable. An adjunct increases its buddy. A contra decreases its buddy. So discount on bonds payable would decrease the bonds payable account when we report it on the balance sheet. Premium on bonds payable will increase. It's still interest though, and we will write that off or recognize that interest over so much money over the next 5 years. And we're going to be showing you how we compute that. Remember, the book value when it's a discount of the bond is face value minus the amount of discount balance, the balance in your discount on bonds payable. The book value when you sell it at a premium is the bonds payable plus the premium on bonds payable balance. Now, what happens if a bond is sold between interest payment dates? When a company sells a bond between interest dates, the company normally will collect from the investor, so the person buying the bond, both the selling price and interest accrued on the bonds from the interest date prior to the date of the sale. What does this mean? Let's look at an example. One thing to keep in mind is that when you buy a bond, the company doesn't go, oh, look, they bought a bond. We better just pay them 6 months interest or 1 year's interest from when they bought it. No, they don't. Okay. The bond or the company says, we have bonds dated January 1. Every December 31st, we're going to pay interest on them. We don't care when you owned it during the year. If you own it on December 31st, you're getting the interest check for the full year. So keep that in mind. On March 1st, Grimes Corporation issues 800,000 10-year bonds dated January 1, 2016 at par. Okay. The bonds have a contract interest rate of 12% and pay interest twice a year, January 1 and July 1. Now remember, the bonds started accruing interest or incurring interest January 1 because that's when they're dated. They were sold March 1st. Whoever owns the bonds on July 1 will receive 6 months worth of interest. So how much do they sell these bonds at? Well, they determine the amount of interest that is accrued on these bonds from January and February because really they shouldn't pay that. They shouldn't pay those 2 months worth of interest. So take 800,000 face value, not selling price, face value, times the contract interest rate, 12%, times 1/2. That'll give you 6 months worth of interest. Or you could just say, how much is 2 months worth of interest? But remember, if you take the 800,000 times 12% times 1/2, $48,000 is the interest payment whoever owns it on July 1 is going to receive. So the company is paying out $48,000. But do they really owe $48,000? No. How much do they owe? 4 months worth of interest, March, April, May, and June. So what they do is they say, okay, well then the first 2 months, so 12, or you could take 48,000, that represents 6 months worth of interest. Multiply that by 2. 16,000 of that we're going to charge to the bondholder on the day of the sale. They're going to give us that cash up front. Okay? They'll get that they'll get 48,000 when we pay the bond interest. 6 months worth of interest. But they're not entitled to 6 months worth of interest. They're only entitled to 4 months. So they're going to pay us the other 2 months the day they buy the bond off of us. So we credit bonds payable. We credit interest expense because when we pay the interest, we'll debit interest expense for the full 6 months. We're crediting it for the 2 months that really isn't an expense to us. And then we debit cash for the full amount we are charging the bondholder. So this is a great chart. January 1, there's interest accruing on this of 16,000. What's the bondholder entitled to? Really the interest from March 1st to July 1st. How much interest are they going to get paid on July 1st? 48,000. But remember, they paid us $16,000 of it up front. So in the end, they're only getting $32,000 and we're only expensing $32,000. Okay. Now, here's the other magic of the bonds. When we are calculating information at an interest payment date, there's a couple of key calculations. The first is we must calculate interest expense. Interest expense is calculated based on the effective interest rate and the book value of the bond. We'll show you that in a second. The effective interest rate the day the bond sold. What's that? The market rate. Multiply that by the book value. Cost, or face value, I should say face value, minus discount, or plus premium, times time. That'll give you how much you debit interest expense for. Not credit cash, that's not how much you're paying. That's how much you debit interest expense for. That's all you're calculating there. You also calculate the amount you're paying for the interest. That's based on face amount times stated interest rate times time. That's the amount of cash you're paying. So you have one amount you debit interest expense for, one amount you credit cash for. The difference is what you will debit or credit your premium on bonds payable for. This is the effective interest method of expensing that interest, that discount or premium. In the year of sale, you can't recognize all of that discount or premium as interest. We recognize it over the life of the bond, and this is the method that is normally used to do that calculation. I'm going to take you to your book. I not want to just read it. I want you to see this. So on page, got a great amortization here. 14-13. Okay, 14-13. Okay, so there's our calculation. The first column on our schedule here is the date. The second column is how much cash interest is being paid. How do we calculate that? The face amount of the bond, not the selling price, the face amount on the bond contract times the stated or contract interest rate on the bond times time. So if it's once a year, you just multiply it by 1. If it's twice a year, by 1/2. So that remains constant. That's in stone. That's the bond certificate amount. That's saying we're going to pay you this much, bondholder, on the face value. The second computation is the effective or the interest expense calculation. That's how much you debit interest expense for. So cash is being credited for the first amount. Interest expense is being debited for the second amount. How do you calculate that? You're keeping a track of your book value of your bond. Remember, book value is carrying, or face value minus discount on bonds payable, balance, or add the premium on bonds payable balance. You take your latest balance, so the beginning of the interest period time period, the book value at that date, times the effective or market rate of interest, times time, 1 or 1/2, depending on how often the interest is paid. That's how much you debit the bond for, or the interest expense for. The difference between how much cash you pay and how much you debit interest expense is how much you either reduce the discount or premium. So on page 14-13, the first table, 14.1, the bonds were issued at a discount. So you will credit the discount on bonds payable account credit it. You're going to reduce it. That's how much of that, quote, interest is going to be recognized this year. 508.35. It's already an interest expense. You just did that. What does this mean? Well, that just reduced your discount on bonds payable, which will now increase the carrying amount of the bond, because if you have less of a balance in the discount on bonds payable, then face value minus the newest balance in discount on bonds payable will give you a higher book value. It's that new book value you'll use to calculate next interest period's interest expense. Let's take a look here. After Jet Company sold bonds for $976.39, it had a market rate of 14%, and that's the rate you'll use to compute and create this table. It records the first interest payment as follows. Debit interest expense for the carrying value or book value of the bonds times the effective interest rate times 1/2, because it's twice a year. Credit cash for the amount promised to pay. Remember, they're paying on face value at 12%. That's right on the bond certificate. And then multiply that by 1/2. And the difference then is credited to the discount on bonds payable account. The new book value at the end of June 30th will then be used to compute next interest period's interest expense. So you would take the $93,484.74 times the effective interest rate at the time of the sale, 14% times 1/2. Now you'll debit interest expense for $65,43.93. Still credit cash $6,000. That doesn't change. The difference is how much you reduce the discount on bonds payable. So you just recognized essentially $543.93 of that discount on bonds payable. So you're showing or recognizing the discount over the life of the loan, of the bond. Okay, and you could see how this carries through. Now, what if Jet sold these for a premium? And that's what the table below will show. You do the same calculation. You use the carrying or book value of the bond. In this case, then it would be face value plus the balance of premium on bonds payable. So for your first calculation, it would be 107,721.71 times the effective rate the day they were sold, 10% times 1/2, because interest is paid twice a year. So you would debit interest expense $53,86.09. The amount of cash being paid out is the same. That doesn't change. It's face value times interest rate times time, stated or contract interest rate on the bond. The difference is debited because we want to decrease the premium on bonds payable account. The day we sold these bonds, we increased it on the credit side. So to decrease it, we debit it. So that's how much of this interest, this difference in selling price and face value due to interest rate change or differences, we show in our books this year, $613.91. Remember, when that occurs, you just decreased your premium account. So now you have to calculate your book value. So it'll be the 100,000 face value plus the new balance in your premium account of $7107.80. And then you would use that new balance to calculate interest for the interest payment on December 31st, 2016. Notice the cash does not change. That's in stone. It's a contract. It's on the bond. Face value times stated interest rate times time. That's how much cash is going out. The interest expense, though, will vary because of the difference in market and stated interest rates. So we take the new book value times 10%, which is the market interest rate on the date of sale, times 1/2. Debit interest expense $53.55.39. The difference is debited to decrease the premium on bonds payable. And then this would continue to occur over the life of the bond. Now, what happens when there's bond issue costs? Maybe you have to pay for legal and accounting fees. You got to pay for printing or registering them. These are recorded as an asset, like a prepaid expense, and they're amortized over the life of the bond by what we call the straight line method. So, we have Graham Company issues 10-year bonds with a face value of $500,000 at 104. So 100 would be 100% or the par value. 104 is 104%. Convert that to a decimal numbered 1.04. So it would be 500,000 times 1.04. So they actually sold for $520,000 cash. There were costs connected with the issue of $8,000. So up front, they received 520 minus 8,000, or 512,000. Why did they get less? Well, first they have that $8,000 deferred bond issue cost of $8,000. They debit an asset called deferred bond issue costs. They then credit the bonds payable for the $500,000, and these really sold for a premium of $20,000. So we want to be careful and keep that $8,000 and that $20,000 separate. Credit the adjunct account premium on bonds payable, $20,000. You will expense. You will do your calculations for the effective interest method at each interest payment the same way as you would without any bond issue costs. The bond issue costs would be divided by 5 and recognized each year. 5 years, 5-year bond, recognize 1/5 of them as an expense each year. Instead of expensing them all in the year of sale, expense them over the life of the bond. Okay, we're just making it evident that when you sell a bond at a discount, interest expense is always greater than the cash you paid. When you sell it at a premium, interest expense will be less than the cash you paid. Why? Because you're trying to only pay the bondholder net what the market rate of interest was at the date of the sale. Remember, on a premium, the bondholder pays more for the bond than it's worth than its face value, because they're actually paying you interest up front, because you're paying them more interest than other bonds. And the opposite is true for selling at a discount. One last thing we want to show you for part 1 is another way to expense your discount on bonds payable or premium on bonds payable. And it's called the straight line method. And it's really easy. It's more simpler and easy than the effective interest method. So discount or premium is expensed and amortized in equal amounts each period during the life of the bond. Recall Jet Company sells bonds for $92,976.39 on January 1. So they sold them at a discount. Interest is paid semi-annually. So what they'll do is they'll record, of course, the sale of the bond and the discount. The discount is $7,023.61. Each interest payment, so we determine the number of interest payments. 5-year bond, twice a year, that's 10 interest payments. We divide the total discount right up front by 10, and each interest payment date we will credit the discount on bonds payable, $702.36. So we don't use effective interest method. We just say how much discount on bonds payable was there overall, and spread that out evenly over the 10 interest periods. So we would credit cash because we're still paying the cash out, but we would credit discount on bonds payable, $702.36, and then add those two together to get your interest expense. So our interest expense in this case is a plug. It's just the two amounts added together. So we wouldn't be doing any calculations on book value or anything like that. Now, what if we sold at a premium? Well, we would do the same calculation. In this case, we would take the premium on bonds payable account divided by the number of interest payments, and that's how much we would decrease the premium on bonds payable each interest payment date. So When our first interest payment come up, we would credit cash. We would debit premium on bonds payable for the calculation of 772.17, and the difference is what we debit interest expense for. So that's the plug. No amortization schedules or calculations beyond that. Okay, and that's how your premium on bonds payable would end up. So you would still you would still need to know the carrying amount because that's what's going to be reported on your balance sheet. But you don't need the carrying amount to do any calculations with regards to your journal entry. The final area I want to talk about before I end this part of our presentation is accruing bond interest. You know, sometimes we don't always have that luxury of our interest payment occurring the last day of the year. Sometimes our interest periods stagger between 2 accounting years. It may start in one accounting period, but the actual interest payment occurs the next accounting year. This results in interest expense having to be recognized for at the end of one accounting year before the payment is actually made. So let's take a look. Olivia Company issues 200,000 10% 5-year bonds on October 1st for $185,279.87. Interest is payable on October 1st and April 1st, and their year ends December 31st. So there's the cash, how it would, and the journal entry to record the sale of the bond on October 1st. Okay, but how would we record interest? Remember, interest would start occurring on this bond on October 1st. Actual interest payment doesn't go out till April 1st. So we have 3 months of interest occurring this accounting year and 3 months of interest accounting next accounting year before the actual interest payment is made. So at the end of the fiscal year, Olivia must accrue interest and amortize the discount that has occurred on October, November, and December. So if they use straight line, they would take 200,000 times 10% face value times interest rate times time, 3 months. That's how much interest they would owe the bondholder. That's how much interest they owe the bondholder. They would take the amount of discount on bonds payable divided by the number of interest payments. That'll give them 6 months worth of interest. They need to know 3 of those 6 months that they need to credit discount on bonds payable. And that's how they got the 736.01. Add those two together and we debit interest expense, 5736.01. This is the portion of the interest that's occurred by the end of this year, even though we don't have to pay it till next year. We still got to accrue. Assume the same facts as before, but this time assume they use the effective interest method. Now, I guess it's not harder. You just have to think about your computations. We would take the carrying value of the bond times effective interest rate of 12% times 1/2. That's how much of the that's how much interest expense there would be for 6 months. How much would there be for 3 months, October, November, and December? 3/6 of that, $55,58.40. So we would debit interest expense, $55,58.40, credit interest payable, no cash is going out December 31st, for the amount of interest that would have been paid if it was due to the bondholders on December 31st. And then the difference is credited to discount on bonds payable. So you still need to worry about accruing for interest. So I'm going to wrap it up there and pick up with our next part and finish up chapter 14.